Hello and welcome to Between the Lines, the podcast that dives deep into the stories redefining Asia Pacific's reinsurance landscape. Recorded here in the newsrooms of InsuranceAsia News in Hong Kong. I'm Mithun Varkey, Editor-in-Chief for InsuranceAsia News. And in this episode, we will discuss results of the big Japanese insurers, rising hail losses in the region, especially the recent event in Beijing, recap Q1 cat losses, as well as the leadership change at Lloyds. We'll also bring you insights into the stories we're working on and leads we're chasing. Our special guest for this episode is Helen Ye, founder and chief executive of Hong Kong-based MGA, Qubit Underwriting. Helen will talk about her journey founding an MGA as well as about the digital asset insurance sector. It's really interesting, the two front lines of innovation, MGAs and crypto, meeting here in Hong Kong.
The nature of our business is we are setting a promise. The promise is to say, if you pay your premium, when you are in trouble, as agreed, we will pay you the claims. If an underwriter doesn't really understand what he or she promised, then when the claims arises, the underwriter will say, this is not my underwriting intent. And then we're getting into a distrust relationship between the digital asset industry, where insurance is much needed and demanded for, versus the insurance industry already very cautious and suddenly hit by a claim that they don't understand, they don't want to cover, they never intended to cover. And that distrust is very damaging to the long-term development of both sectors.
I'm joined by the InsuranceAsia News editorial team, Deputy Editor Andrew Mullen and Special Projects Editor Kristina Shperlik. Welcome, Andrew.
Good to be back.
Welcome, Kristina.
Hello.
Joanna Nguyen is not joining us this episode. She's ditched us for a Lady Gaga concert in Singapore.
And she's not the only one. I think we're the only people here in this office who didn't go to that concert.
So, what do we have today?
So, first of all, we had a busy night in the office on Tuesday night with the three big Japanese insurers announcing their results. They reported record results in the latest financial year that ended on March 31st. This was due to stellar overseas growth, benign nat cat environment, and foreign exchange gains. Domestic markets have benefited from rate increases across motor and fire classes, and as I mentioned, benign cat environments. Overall, the results were a mixed bag as insurers were hit by rising unit repair costs. MS&AD's domestic P&C businesses posted strong growth. Tokio Marine's Japan growth was modest, but Sompo actually saw a decline. Elsewhere, Sompo and MS&AD's international arms posted robust growth. However, Tokio Marine's international business only grew marginally.
Yeah, it's quite a mixed bag this time. Usually there is a trend among all three companies, but this time it was a bit of a, MS&AD's domestic business did significantly well, whereas Tokio Marine underwriting results were quite flat and Sompo sort of declined, which is kind of interesting because there have been some rate hikes, especially the motor and fire lines, and there weren't big losses in the region. But I think one thing that's quite interesting, Tokio Marine, for example, had a one-off adjustment from their liability exposure in the US. So there were, one-off adjustments to these results. So there's a bit more nuance to it. But it's fair to say that all three companies have had significant top-line growth.
Talking about benign nat cat activity for MS&AD and Sompo, nat cat losses remained flat, around the same as last year. 162 billion for MS&AD, 152 billion Japanese yen for Sompo, and around 150 billion for Tokio Marine. A hailstorm in Hyogo last year became the most expensive catastrophe in Japan, and it cost over 50 billion for Tokio Marine, around 50 billion for MS&AD as well, and over 30 billion for Sompo. Typhoon Shanshan was the other big event. It cost Sompo 22 billion in losses, and a little bit less for MS&AD, 18 billion and 16 billion for Tokio Marine. Also, all three carriers were impacted by Los Angeles wildfires. MS&AD recorded total amount of 40.5 billion losses, and we also saw estimates from Tokio Marine, around 27 billion and around 22 billion from Sompo.
What's interesting about the cat numbers from Japan is unusually it's the hailstorms that have been the big loss drivers. Typically it's typhoons or earthquakes in Japan, as we know. There were 3 big hail events in Japan last year, and there's been a lot of discussion around severe convective storms. especially the US last year. But we're seeing more of it in Asia as well. And most recently, last week, we saw a very rare hail event in Beijing. Kristina, you were talking to insurers and loss adjusters in China. Can you tell us a little bit about what happened in Beijing last week?
Yeah, so we saw a very strong hailstorm in Beijing last Tuesday. The latest loss we saw, so the estimate for insured losses is around $44 million US, which probably we will see an update soon. Mostly this loss is coming from motor and property damage reported around Beijing. We just got the latest update from Pinyan yesterday. They received over 25,000 claims and they've processed around 3,000 claims so far, which is equivalent to around 7 million yuan.
Yeah, I saw those videos online. They were comparing the hails to the size of eggs. How did this happen?
Yeah, you're right. The hailstones were at least 4 centimeters in diameter. And this event is not typical for Beijing, as we know. So typically Beijing can be affected by smaller hailstorms that are more localized. So this time the hypothesis is that the storm was so severe because of the convergence of warm and cold air masses. And ironically, it was because very high daytime temperatures of over 30 degrees has caused some very big atmospheric energy accumulation. And that combined with moisture-filled and tense convective weather. Yeah,
what was interesting is there was a video of a Volkswagen dealership with damages. And this was windshields, smashed roofs. And there was these kind of like sieve-shaped dents. It's interesting in China that some motor reforms that came in 2020, hail damage, which is car roofs, sunroofs, windshields, has been included in motor coverage. So it means people are going to get covered for this.
That means the insured losses are likely to go up significantly in the coming days. So last couple of weeks, we've seen a recap of Q1 cat losses. It's quite a busy cat season in the first quarter, unusually high losses, especially driven by California wildfires. We've had reports from both Aon and Gallagher Re. Kristina, can you recap the numbers for us, please?
I will talk specifically about Asia-Pacific events. The numbers are really easy to remember, actually. It's always 1 billion. So we saw big wildfires in South Korea and Japan, and combined economic losses are now over $1 billion. The costliest event this quarter was ex-tropical cyclone Alfred, and insured losses are approximately 1 billion Australian dollars this time. And of course, the biggest event in the region was the Myanmar earthquake in March. We know that the insured losses there will be low because of the protection gap, but economic losses are expected to reach billions of dollars.
Talking about recaps, we had quarterly results from the big reinsurers last week. They had some interesting numbers on April 1 renewals. So one thing that we saw at the January 1 renewals was that demand was flat in the region. So a lot of the reinsurers didn't really manage to grow their books. But interestingly, at the 1-4 renewals, at least from the results of the top 3 reinsurers, Munich Re, Swiss Re and Hannover Re, it does look like they've been able to grow their books. But what did strike me was that Munich Re and Hannover Re reported a softening in the rates. They both said that prices, so Munich Re saw about 1.7% risk-adjusted reduction in prices. So did Hannover Re reported slightly higher reduction in prices, around 2.4%, I think. But Swiss Re managed to report price increases, which I thought was quite interesting. We'll see more details in the coming results, I believe. Andrew, you've got something for us on the Lloyd's leadership transition.
Yeah, so unless you've been living under a rock in the insurance world, you should have seen that Lloyd's will have a new CEO. Patrick Tiernan is coming over from his role as Chief of Markets. He's going to start on June the 1st. But he used his last, I guess, big public appearance before taking the top job to issue a warning to syndicates. So let's remember there are 15 Asian service companies based in Singapore. And Patrick Tiernan used this Q2 message to warn them, and he used some quite colourful language. He said that they are basically currently using surgical tools to fix things, but if the market doesn't self-diagnose, they're going to have to use blunt instruments, which I guess put the syndicates on warning that things need to change. He did say that they've delivered growth over the past 4 years, but he said that if these blunt instruments were needed, it would be a travesty given the efforts that's been made in recent years.
That's some strong words from the incoming CEO there. It's likely that we'll see some changes in Lloyds. We've covered a lot of ground there. So what are we all working on now? Kristina, you're on to a climate change impact story. Tell us about it.
It's very interesting because in Asia Pacific, farmers grow many types of crops that are particularly vulnerable to climate change, such as vanilla, pepper, clove, cocoa. They're very sensitive to temperature fluctuations and they can quickly die because of extreme weather events such as storms and droughts. Some regions in Asia Pacific, such as Southeast Asia or Pacific Islands, they're very sensitive to this problem because farmers there they depend on a single crop, so they can lose their whole harvest because of extreme weather. Insurance products are evolving to address these risks through tailored policies and integration of technology such as satellite data that can improve risk assessment. And of course, parametric insurance can trigger payouts based on weather indices rather than the actual losses, and they can provide quicker financial relief to these farmers.
It's interesting. It's not just Southeast Asia. I think, Andrew, you were looking into vineyards in Australia.
Yeah, I was going to say I'm taking a sip of this sector as well. There was a report from Descartes recently suggesting there was a lot of opportunities in Australia for brokers especially. They were comparing it to the French market. Obviously, France and wine, very famous, and that their insurance market there for wine is very developed. Australia does have one, but this report suggested there's a lot of opportunities in this region, in this area. So we're looking into that, reaching out to some different stakeholders and also some wine and grape associations and seeing what the coverage is like, and also asking them what the impact of parametric insurance and parametric solutions could have in this sector as well.
Talking about Australia, we're also looking into the re-elected Albanese government and what that means for the insurance sector. What are the angles we're looking at?
So I think one interesting angle is tax. We recently heard from Qubit chairman Mike Wilkins, who was suggesting cutting insurance taxes, and basically for him, this is the fastest way to bring relief to customers hit with higher premiums. It's an astonishing figure that Australia's state government insurance taxes raised 3.5 billion Australian dollars. This is more than the entire industry's profits last year. Of course, it's interesting for us how the insurers and the industry bodies will work with the re-elected government, not only about tax, but also about building resilience, which I think is always one of the biggest topics in the country.
The insurance sector was part of the build-up to the election, and on the campaign trail, Peter Dutton talked about breaking up the insurance sector. Now, that didn't work well for him, but it's clearly a topic that's been on everyone's mind as well.
And something that we touched upon last episode, the captives market in Hong Kong. We're working on a story around that. Obviously, Hong Kong has been competing with Singapore to push itself as a captive hub, one might say with not much success, ODS. So HSBC's announcement of a new captive in Hong Kong breathes new life into Hong Kong Insurance Authority's efforts. Earlier this week, they were holding an event in Beijing trying to attract more captives from China. So we're trying to understand what the Hong Kong Insurance Authority is doing to attract more international interest. Sounds like a great news list. Plenty of exciting stories to watch out for and to work on. Let's get back to work. And as Lady Gaga would say, remember to keep your poker face. Next, in our featured interview, we'll hear from Helen Ye, who is the CEO and founder of Qubit, a digital asset specialist MGA based in Hong Kong. Qubit, which is a Lloyds cover holder with capacity from Canopius, has also recently launched in Australia. Helen will take us through her journey of founding the MGA and discuss crypto insurance. Hello, Helen. Thank you very much for joining us. How are you doing? It's pretty hot outside.
It's very hot, and hopefully we will have a very heated discussion here as well.
Thank you very much, Helen. To kick off, can you tell us how you came about setting up an MGA in Hong Kong? Technically speaking, Qubit is the first MGA to be licensed in Hong Kong. So can you tell us about your journey?
Sure. You remember Steve Jobs used to say that if you look back into your life, you will feel that you are connecting dots. So I feel my career life is like connecting dots. I first heard about MGA back in 2014 And it was more about in the development markets in London and also in the US. I thought it was a very good model because it was a true test of the underwriting skills of underwriters. However, at that time, it was not very popular with insurance companies. The reason being that after a very long time of losing money from this distribution channel, most of the insurance companies already closed their doors to MGAs. MGAs started to become popular again in recent years for several reasons. I think one is because MGAs started to become very specialized, and we have seen people very specialized in distribution using digital platforms and to do embedded insurance, for example. And that is the kind of distribution new to insurance companies. And it's very difficult for them to replicate the technology innovation. So therefore, it's easier for them to engage in an MGA to achieve this distribution efficiency. The second point is we increasingly started to see emerging risks. So for example, cyber. So when cyber first started, if you look at the big underwriters in today's market, they all started as MGAs because you have the combination of technical expertise together with the flexibility of designing and structuring and customizing your coverage. And that kind of flexibility is very difficult to achieve in a very formalized and very large insurance companies. And so insurance companies, if they're interested in emerging risks, that is the best way for them to approach. The third reason is increasingly we started to see very diversified capital structure in the insurance market. So in the past, if you are an investor, there are not many diversified ways for you to invest into the what we call to become a risk capital. You can invest into insurance, reinsurance, or maybe sidecars. Or started about 15 years ago, you can do ILS.
Right.
But with the MGA, you can actually be closer to the risk. So MGAs started to become a vehicle. They can bring directly the risk into the capital. And using insurance and reinsurance only as a vehicle. And then that gives the risk a lot of flexibility as well. And I think because of that, then we also started to see more and more MGAs starting off in this market. Again, insurance companies and reinsurance companies, they have learned their lessons, why they lost a lot of money by supporting MGAs. So this time around, I think they are more prudent, they are more targeted, and they know how to manage this distribution channel better. So therefore, there is better collaboration and partnership. And that's why this entire market creates an opportunity for me to actually set up an MGA here in Hong Kong. And as I believe it is a very niche market, and it is still quite new actually in Hong Kong. And that's why I decided to set up Qubit, because Qubit actually basically meets all of these criteria. We have specialized distribution. We are very much a specialized underwriter. And we also aim to bring new capital, new capacity into the market.
Interesting. You mentioned that insurers were skeptical, and that's kind of changing. But what's also true is on the other side, the regulators, certainly in Asia, remain very skeptical of MGAs. Even including Australia, which has a lot of MGAs, there seems to be a regulatory skepticism. The market, still the brokers, the risk owners, risk managers, there's still a bit of skepticism around MGA. So what has been your experience? You've had about a year since you launched the MGA. What's been your experience going to the market, speaking to the regulators, especially in Asia?
You are absolutely right. I think regulators are very cautious about this. And there are only 3 markets in Asia Pacific explicitly allow MGAs. That'll be Australia, Hong Kong, and Singapore. And of course, because I'm based in Hong Kong, and Hong Kong is naturally my choice to set up Qubit. It took us quite some time to work through the license application process. but eventually we got there. And I think the Hong Kong regulators are, relatively speaking, quite friendly, even though they are very strict in their regulation and very prudent, but they are quite open-minded and friendly. And I think in this year's Lloyd's Day, Hong Kong IA actually made MGA one of their development directions. They believe that Hong Kong should welcome and has the marketing environment to welcome more MGAs, and that will be very beneficial to the market. And exactly for the reason I just mentioned, because I think they see in this very traditional market, MGAs will be able to bring new distribution, underwriting expertise, and maybe new capacity. And that's why they're increasingly becoming very supportive. The regulation of MGA, however, in Hong Kong is not a specialized area, because, as you said, we are technically the first approved MGA in the market. But I think Hong Kong IA also published a newsletter and with the very focused topic on MGA. So I think it is something that they have been thinking about. They have been probably internally and externally discussing, both among themselves, but also with the market players. So I do expect to see more MGAs developing and growing in the Hong Kong market. Singapore market is, relatively speaking, more restrictive. And they differentiate between Lloyds and non-Lloyds MGAs. And of course, that actually created a lot of regulatory burdens to the MGAs trying to set up and underwriting the Southeast Asia business to some extent. Australia is having new regulations coming around the MGAs, but I think it is actually trying to create a kind of supervision, I'll say the closer supervision between the risk carriers and with their distribution channels. And so therefore tie in a lot of the discipline in the underwriting and in the risk management. In the long run, I think it is good actually for the market. But Australia also we need to keep in mind is it's a very developed market. So therefore it does actually have a lot of, different approaches to, for example, Lloyds versus non-Lloyds. And that gives a lot of the Lloyds cover holders and development sort of advantage in that market as well. So overall, I think the reason that regulators are becoming more aware and trying to regulate more the MGAs is exactly because they see the development potential of MGAs in this market, of driving this market. So therefore, that's why they wanted to get ahead and trying to make sure that we are not repeating the history.
So you feel that regulators are warming up to the idea of MGAs. I'll come to Australia in a moment. I want to talk about Australia. But what about the market? What about brokers? I mean, the key differentiator, as you said, is the distribution model that MGA brings. And when you talk to risk managers on the other side, are they receptive to the idea of MGAs? Do you have to do a sales spiel, as it were, before you actually start writing that risk?
That's a very good question. It really depends on the market. So in Australia, for example, it's a very mature business model. We don't need to explain to any broker what is an MGA, what do we do, why you should work with us. In Hong Kong and in Singapore, we indeed actually went through a process trying to convince some big brokers why they should work with us. The immediate reaction from some brokers who are not very used to working with MGAs would be, if you represent a risk carrier, why can't we just go directly and place that risk to the risk carrier? Yeah. The answer is they don't have the underwriting expertise, but they are willing to give us authority to represent them. Another myth in this market would be brokers say, but if I place the risk directly to the risk carrier, and then we are cutting the intermediaries in the process, isn't that actually achieving better pricing for the customer? My answer to that is not necessarily, because if you go to a risk carrier, when they price the risk, they also have management costs. And that management cost has not effectively been outsourced to an MGA, right? But we don't have that problem anymore these days in the market. I think one of the reasons is because we are offering capacity to a very much niche area where capacity is very much needed. And also we have demonstrated to the brokers that we're working with that we indeed understand this sector of risk. We indeed can structure the kind of solutions that can help their clients. So that is no longer a challenge for us.
Great. So I was coming back to Australia. I mean, it was just this week that you announced that you formally launched in Australia. So congratulations on that.
Thank you.
So as a Hong Kong MGA writing business around the region, so can you just walk us through Qubit's regional strategy? You're based in Hong Kong now, we have an office in Australia. What's Qubit's regional strategy?
Right. When Qubit was set up in 2023, from day one, our strategy, our vision is to become an leading underwriter in the digital asset space across Asia Pacific. And that is because of the very nature of the digital asset industry. Our players are not localized companies. When they do business, they do cross-border business. Many of our clients, actually, they have set up here in Hong Kong, in Singapore, maybe in Dubai, and some of them actually will also have licenses in BVI. So they are catering to a much wider, or actually, I would say, clientele without border. So we need to understand that. And the second thing is, when we talk about digital asset, we're talking about a specific technology sector. That technology sector has hubs. And the hubs that we're talking about here are Singapore, Hong Kong, Australia. So naturally, when we talk about distribution, when we talk about how we want to develop and grow a portfolio, we're talking about Asia Pacific as a whole, or even go beyond Asia Pacific. And that's why it's very important for us that we have access to that market. We have presence to the market. We understand, we have connections to the market, to the clients. And that will help us to better structure the solution and for the clients. So from day one, that was our vision. Of course, insurance is a highly regulated sector. So we have to make sure that we take this slowly, and we do have proper and compliant setup, and we also have the right people to service the market sector. So yes, it took us almost 18 months to finally actually set up in Australia, but that has always been in our plan.
Okay. So let's talk about digital asset insurance market, and you're a specialized player in that space. Certainly very few players globally, and certainly so in Asia. And the crypto markets obviously have been through their upheavals, and capacity has come and gone. Things seem to be settling down. I mean, how do you see the opportunities for the crypto insurance market globally and in Asia? What sort of trends are you seeing in the market?
Right. I first started to really understand the digital asset as a sector back in 2020, when a Hong Kong VASP applicant actually came to me and asked me, can you insure us? At that time, I had no idea what they do, right? Of course, I heard about Bitcoin, but what is an exchange? What is custodian? Why don't you use banks, right? Since then to now, it's only about 5 years. And it's exactly 5 years because the first inquiry I received was in May 2020. In that 5 years, technology has changed so much. If I think about how I look at the risk back in 2020 versus how I look at now, I remember the first proposal form we developed, it was about 17 pages. But today we have reduced that to 7 pages. The first policy form we developed, we probably had about 30 exclusions. Today, we feel very comfortable extending the majority of the extensions to our clients as if they're a traditional financial institution. Yeah. Of course, we very much focus on specific crypto unique exclusions because that's just unique to the industry. But this 5 years is a journey where we started to develop a much deeper understanding of the technology, of how people use that technology. And by using that technology, what's the vulnerability and what's the risks are associated with deploying that technology. And also, more importantly, is we have witnessed the market up and down, actually. So we have been through 2 cycles, right? Yeah. That's a lot in 5 years of time. And also we have seen the up and downs in the general regulatory environment globally, in the US, in Europe, in UK, in Hong Kong, and also in Australia. So we understand a lot of the risks that we're underwriting. We know the people that we are trying to underwrite. So that's actually put us into a very unique position to be able to offer the kind of coverage. So if you ask me to say, I've been asked a lot of these questions to say, why do you think the traditional insurance companies won't be able to do it? My answer is, it is, knowing what I know now, I think it is quite prudent for traditional insurance companies not to do it. I have seen some traditional underwriters without much understanding of the digital asset industry coming in and price the risk very aggressively. And without specific exclusions that may actually get them into trouble. Mm-hmm. And that is not good actually for the digital asset industry, and that is not good for the insurance industry. Insurance industry, the nature of our business is we are setting a promise. The promise is to say, if you pay your premium, when you are in trouble, as agreed, we will pay you the claims. Right. If an underwriter doesn't really understand what he or she promised, then when the claims arises, the underwriter will say, this is not my underwriting intent. And then we're getting into a distrust relationship between the digital asset industry, where insurance is much needed and demanded for, versus the insurance industry already very cautious and suddenly hit by a claim that they don't understand, they don't want to cover, they never intended to cover. And that distrust is very damaging to the long-term development of both sectors. Mm-hmm. So that's my first observation. My second observation, obviously, is I think because this technology, the services, the products, the people, are still in this fast developing and evolving phase. For any insurance companies trying to put it into a framework, into a so-called consistent framework, they will find it very demanding. So to underwrite this risk, you need to have a very agile approach, which means that you need to look at your coverage constantly, review it, trying to answer the question, do I really understand what I'm covering? Is this my intent? Do I feel comfortable covering it? Do I know if I give this coverage to the client, what it actually means? And I think a lot of insurance companies for the very, very intended underwriting framework that is not in their operations. Okay. So it's very similar to how cyber insurance actually started. Right. People don't understand it and don't understand the consequences of claims actually arising. So they leave it to the MGAs to develop it. And then when the market started to mature, when you are able to, as an insurance company, provide commoditized products, yes, then you can actually have all the capacity coming into the market. Digital asset industry is not there yet. But of course, it is attracting a lot of attention as it grows because the demand for insurance will continue to grow.
Right. Have you had sorry, have you had enough claims experience and claims data as an emerging business? And what's been your experience in terms of claims from the crypto industry?
So, as an underwriter, I've been underwriting crypto risk for now almost 5 years. And luckily, I personally, we haven't had any claims yet.
Okay.
However, knowing that we haven't had a claim, we become very cautious. So we did two things, right? Even before we developed the product, we collected all the incidents in the industry, going back from 2012 all the way till today. That's about 800 incidents that happened. And then we started to look at database and we started to try to make sense of the database. And that's why I said that will give us a lot of insights into what are the risks that we're dealing here, right? So I'll give you a specific example. When I first started to offer a product to cover custody risk and exactly what coins are we going to cover? And it was a long discussion. And we started to have a long list of exclusions. And by year 3, we look at our data again, and what we realized is 91% of losses are Bitcoins. Another 5% are Ethereums. Combined, that's 96 already.
Right.
And we spent months actually arguing about all the other coins, and we put a long list of exclusions. It doesn't really matter.
That's interesting.
Right?
It's not the meme coins.
Exactly. No. Right? So therefore, it started to shift your focus, right? And a lot of our clients also come to us and say, why are you, covering, for example, employee theft? We don't think that's a very important risk, right? And we say, do you know the majority, 80% of the risk, the losses are associated with employee theft? So then we give them all these, data. And they said, oh, we didn't know, right? So that's why what I'm trying to say is it is constantly a evolving market. And we still actually continue to collect our data. The difference between 5 years ago versus today is 5 years ago, we were doing this all by ourselves, right? We have, a few interns, a few young guys, what we call crypto native, research, R&D guys collecting the data. Today, we expand our collaboration and network. We talk with very experienced, Web3 specialized auditors where they make industry standards and they bring that expertise and they also actually collect their data. So we combine them and we are now leveraging some of the smart tools and deep learning experience into this. And we're creating some risk analysis tools. So hopefully by doing that, in the future, when, digital asset risk becomes, I would say, mainstream, and then we're able to actually offer to the underwriters better tools for assessment of a risk, of a particular risk, and also for digital asset as an industry. What is the industry exposure that we're talking about? Is it really as risky as the traditional industries, or it is more risky, but is it larger than, a cow and smaller than a rat, right? That's the question that we are trying to answer.
It's interesting to know there's the whole formal ecosystem evolving around and frameworks evolving around the crypto industry. So just wrap it up. We're interested. What's next for Qubit? How do you see Qubit as a business evolve?
That's a very good question because that's a question we ask ourselves every day. We still believe that what differentiates Qubit from other competitors in the market is our underwriting expertise, and in particular in the digital asset industry. But the digital asset industry has its own challenges, and some of the challenges are very native to the industry. It is still evolving. We have a lot of new buyers. Regulatory environment keeps changing, and so therefore we see that this probably will be another couple of years. At the same time, the question we ask ourselves is, are we going to actually leverage the distribution that we have and leverage the expertise, that the traditional underwriting expertise that we have? And we started to offer, very similar products to the financial institutions, right? And that's something that we are experimenting at the moment. At the same time is, if we are a tech player in this space and we already have the system and we already, have a very efficient distribution, should we actually do something about this very traditional industry here, in Hong Kong and in Singapore, to consolidate a lot of the very fragmented distribution and underwriting? And given that we are one of the very few Lloyds cover holders here, are we able to bring more Lloyds capacity to this market? So that's sort of thinking is constantly being debated among the team members. We haven't actually come to a conclusion, but we do actually started to offer, different products in the market. And so we are still trying to test, which strategy, which approach would actually fit and will enable, Qubit to actually grow a very profitable portfolio and as fast as possible. That's probably the best way to say it.
So looking beyond cryptos as well?
We do. We already started to offer professional lines to traditional institutions.
Great. So it does look like you have quite an expansion plan ahead of you. Thank you very much, Helen. It was a pleasure having you with us. Thank you very much for your time.
Thank you.
That's all for this episode of Between the Lines. Don't forget, you can connect with us on LinkedIn and subscribe to our daily and weekly newsletters delivered straight to your inbox. And of course, we'd love to hear your feedback on the podcast. Email us at editorial@insuranceasianews.com. I'm Mithun Varkey. Thanks for listening.